I'd like to talk a little of risk management in Takaful. It's an area which is being covered by the Islamic Financial Services Board on one of its working groups, and it's an area of importance in Takaful. And the reason for its importance is because in Takaful, specifically in family Takaful, which I will talk about, you have what the IFSB referred to as a hybrid operation. It is neither fully commercial joint stock operation, nor is it fully mutual or cooperative. It is a combination of a joint stock, commercially minded operator entering into the Islamic financial services industry to operate a Takaful company, combined with the mutual cooperative principles that apply to the participants within the risk pool. So the first thing I would mention is that there are some governance and potential conflictive issue that we need to look at. One of the primary one I would discuss is on the underwriting risk. Please consider the following, that the risk is not transferred to the operator, it is maintained within the risk pool, but the risk pool is managed by the operator on behalf of the participants. Now, depending on the adoption of regulations that are in the Takaful area at the moment, a Takaful operator under the IFSB rules may participate in surplus that's generated from underwriting by operating the underwriting on a wakala basis and participating in the surplus on a wakala performance fee. There are other schools of thought in the Takaful industry that an operator should not participate in the surplus, regardless of which contract he operates. But in terms of risk management, what you have is an operator managing the risk on behalf of the participants, which could either generate surplus, if that is the school that has been adopted, or where an operator could be willing to take a higher level of risk with lower pricing on underwriting to try and sell as many products as possible. So we have the managing of the risk on the underwriting side, which needs to both overcome potential conflict and governance with a very, very balanced approach by the operator to ensure that the risks are taken are not to the disadvantage of the participant. In terms of investment risk, we have potential for three areas. We have the investment pool, which has to be invested on behalf of the participants. We have the potential in a family Takaful environment of a savings element, right, which needs to be invested on behalf of the participant. And of course we have the shareholders' funds, which need to be invested on behalf of the shareholder. If I look at the investment funds on a pooled basis, it is acceptable in Takaful that a percentage of the investment return is shared with the operator. This is usually done under a Mudaraba contract, but can, if you so desire, be done on a wakala contract with a performance fee. It can end up with the same result. So you need to ensure again that the operator is not taking undue risks, perhaps highly invested in the equity side on the pool, remembering that the operator is managing the participants' funds. The same for the investment funds. He is managing the investment funds on behalf of the participant. On the shareholders' funds, then there is the risk that if there's no funds available to run the business, if there's bad investments, there is the risk there. So all three risks need to be mitigated. In terms of reputational risk, I've mentioned one area that needs to be considered there, and the reputation risk of managing the client's funds on behalf of the clients, not to engage in investment practices of those funds or underwriting practices of those funds, which would give due cause for the reputation of the company to be questioned. The reputation of the company is the reputation that is needed to have a successful sales environment. Unique to Takaful is the added burden of Sharia compliance in terms of the risk management. This does not exist in conventional insurance. You need to have the Sharia doctrine that has been applied, the Sharia decisions that have been applied. You need to ensure that in the real world, real life operation, decisions at Sharia committee level are implemented in the program, be it within the product development, be it within the contractual development, or be it in the overall running of the business. There is the added burden of ensuring that compliance with Sharia rules are adhered to. Business continuity risk. This can come down to the, as mentioned earlier, the potential of the operator taking advantage of the underwriting situation which they control on behalf of the participants, looking to get a greater level of sales with a higher risk on the underwriting, which could result in very poor results and could result in the need for a Qard al-Hassan being issued by the operator to overcome any deficit that exists. If the deficit continues, where the operator does not reconsider the underwriting or pricing of the product, then you could enter into a business continuity risk.